Reliable trading of UR over CHF and other low beta pairs requires a different approach than high beta or risk on pairs. These pairs, UR over CHF, USD over CHF, UR over GBP, CAD over CHF, etc., are typically lower volatility, more mean reverting, and driven primarily by interest rate differentials, central bank policy, and occasional safe haven flows rather than equity direction or broad risk appetite. 1. Core drivers to focus on. Interest rate differentials, most important in normal markets. Watch ECB versus SNB policy rates, deposit rates, and market pricing of future moves. A widening yield advantage for the euro tends to support UR over CHF over time. Central bank communication and intervention risk. The SNB has a long history of intervening to prevent excessive franc strength. Verbal or actual intervention can create sharp, tradable moves. Risk sentiment only in extremes. Clear risk off, sharp equity sell-offs, VIX spikes, European political stress usually strengthens the franc. In calm or risk-on markets, this effect is weak or absent. Relative economic data, Eurozone versus Swiss growth, inflation, and PMI differentials matter more than absolute levels. 2. Reliable trading styles for low beta pairs. A. Range mean reversion trading. Highest reliability in normal regimes. UR over CHF and similar pairs spend long periods oscillating inside well-defined ranges. Identify clear multi-week or multi-month support resistance. Fade extremes with tight risk. ATR-based stops work well here. Target the opposite side of the range or the mean. This style benefits from the lower volatility and mean reverting nature of these pairs. B. Interest rate differential display-colic strategies. Trades, when the market begins pricing a sustained divergence, e.g., ECB holding or hiking while SNB is expected to ease or stay very accommodative, position in the direction of the higher yielding currency. These moves tend to be slower and more persistent than equity-driven moves. Use a multi-week to multi-month horizon. C. Event-driven safe haven trades, selective only. Only activate when there is clear, acute stress, sharp drop in European equities plus rising VIX plus political or banking stress in Europe. In those windows, the franc often strengthens quickly against the euro. Outside those windows, avoid forcing a safe haven narrative. D. Technical structure plus volatility compression. Low beta pairs frequently form tight consolidations or triangles. Breakouts after volatility compression can be reliable, especially when they align with an interest rate or policy catalyst. 3. Practical risk management rules. Use ATR-based position sizing, as in the script we built. Because absolute volatility is lower, you can usually take larger notional size for the same dollar risk. Keep risk per trade modest. 0.5 to 1.0% is professional for these pairs. Prefer wider stops in ATR terms than you would use on high beta pairs. The noise is lower, but the meaningful moves can still take time. Avoid trading them purely as equity proxies. That approach has low reliability. 4. What usually does not work reliably, simply buying UR over CHF because the Euro Stoxx 50 is rising, or selling it because Swiss equities are rising. Treating them like high beta risk pairs, AUD-JPY, NZD-JPY, etc. Over-leveraging because they don't move much. When they do move, policy shifts or genuine risk off, the moves can be sharp. Summary, reliable framework. You can look at the table in the conversation history. Focus on interest rate differentials and range structure in normal markets, and only lean on the safe haven characteristic when stress is obvious and broad. This combination has historically been the most consistent way to trade UR over CHF and similar low beta pairs.